All right, welcome. Today, we're basically going to be financial detectives. We're diving deep into a massive, high-stakes bet on one of the world's biggest banks. Our job is to figure out the who, the what, and most importantly, the why.
Okay, so this is the central mystery, right? When a massive institution with incredibly deep pockets places a bet this big, you have to know they are not just guessing. They're sending a signal. They believe they have an edge, some kind of insight the rest of the market might be missing. So let's figure out what that is.
First off, let's just let that number sink in for a second. $160 million. On February 9th, 2026, some anonymous institution put this unbelievable amount of money on the line, all tied to what Morgan Stanley stock would do over the next 4 months. Yeah, this isn't just a casual bet. This is a statement, a huge, flashing neon sign of a statement.
All right, so how did they actually place this bet? They did something really interesting. They didn't just buy the stock. Nope, they sold 10,000 contracts called put options. Now, in simple terms, this means they agreed to potentially buy Morgan Stanley shares at $160 a pop. And just for making that promise, they got paid $4.8 million right up front. Sounds complicated, I know, but let's break down what that really means.
Okay, so to really crack this case, we have to get our heads around the financial weapon they used here. Because this isn't about hoping the stock just skyrockets to the moon. No, it's a much more subtle and, frankly, a much smarter bet on just one thing: stability.
So here's the absolute key to understanding this whole thing. Think of it this way. Selling a put option is basically like you're becoming an insurance company, but for a stock. You get paid a fee, that's the premium, and in return, you promise to buy the stock if it has a really bad day and drops below a certain price. The person selling this is basically saying, hey, pay me a bunch of money right now, and I'm so confident this stock won't crash, I promise to buy it from you if it does.
So this all boils down to two possible outcomes for our mystery trader. Scenario 1, Morgan Stanley's stock stays above $160 until June. If that happens, they just pocket that cool $4.8 million free and clear. That's the perfect win. But here's the kicker. Even if they're wrong and the stock does fall, they have to buy 1 million shares, but their effective price isn't $160. It's just over $155 because you subtract the cash they already got. You see? In their mind, it's kind of like a win-win. All right, so we've got the how down. Now for the really juicy part, the why. What on earth gives someone the nerve, the confidence, to underwrite a $160 million insurance policy on Morgan Stanley? Well, the answer is hidden deep inside the company itself. It's a fundamental change that's been years in the making.
And this, right here, is the absolute heart of the argument. See, the Morgan Stanley of today is a totally different beast than it was, say, a decade ago. It's strategically moved away from the wild boom and bust cycles of old-school investment banking and pivoted hard into the super steady, predictable world of managing money for wealthy people.
And you don't have to take my word for it. The numbers scream it. Wealth management is not some little side hustle anymore. Look at this. It is now an equal partner, a twin engine powering this massive firm, bringing in almost as much money as the entire trading and banking division. That's the kind of stable, recurring cash flow that big money investors absolutely love. And if you want the number that backs all of this up, get ready for it. $9.3 trillion. That is the total amount of money that Morgan Stanley's clients trust them with. That amount of money acts like a giant anchor, a ballast, keeping the ship steady no matter how choppy the markets get. And you can really see this secret weapon in action when you put them head-to-head with their biggest rival, Goldman Sachs. Morgan Stanley is pulling in more than double the revenue from wealth management. Not only that, they're way more profitable with a much higher return on equity. And they're more efficient, which just means it costs them less to make every dollar. They're just a leaner, meaner machine, which is why big investors see it as a much safer bet.
But hold on, this trade isn't happening in a vacuum. It's not just a bet on Morgan Stanley. Our trader is also looking at the big picture, at the political and economic winds blowing out of Washington, D.C., and they are seeing a massive tailwind starting to build.
The main event here is something the market has already nicknamed the Warsh shock. The nomination of Kevin Warsh to take over the Federal Reserve is a huge deal. We're talking a seismic shift in policy. Based on everything he's said in the past, he's seen as much more friendly to the big banks and focused on growth, which could kick off a whole new era of deregulation and easier money.
And look at this timeline. This isn't some far-off possibility. This is all happening bam, 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 one thing after another. You've got deregulation, a new Fed chair, and even new rules for AI and banking, all in a really short window. You put all that together, for a company like Morgan Stanley, that's like rocket fuel for their business.
Okay, let's put on our detective hats one last time. We've got all the pieces of the puzzle, the clever structure of the trade, the rock-solid company, and the changing winds in Washington. It's time to connect the dots and deliver the final verdict.
Now this is where the trade gets really, really smart. The market's own math suggests the stock probably won't fall below about $160. But remember that premium? Our trader's break-even point is way down at $155.20. They've basically built themselves this huge cushion, this margin of error, by placing their bet just outside the zone of what's statistically likely to happen.
And when you run the numbers, the odds are just wow. There is an 88% probability that this trade will make money. We're not talking about a coin flip here, not even close. This is a highly calculated play based on a deep understanding of the odds.
And this right here, this quote, it just hits the nail on the head. This trader isn't betting that Morgan Stanley stock is going to the moon. No. They're making a powerful $160 million statement that, given everything we've seen, a real catastrophic collapse below their magic number is basically impossible.
But of course, let's get real. No trade is ever a 100% sure thing. There are always risks. What if the new Fed makes a huge mistake? What if the AI bubble bursts and takes the whole market with it? Or what if something blows up in the private credit markets? Our mystery trader is betting that none of these potential bombshells go off before their options expire in June.
So what's the verdict? Is this an incredibly clever, high-probability bet on a financial giant that's just too stable to fail? Or are they just picking up pennies in front of a steamroller, totally blind to the big risks hiding just around the corner? It's a heck of a trade to watch. Thanks for digging into it with us.